So this is episode 6 of the Tion Talks podcast, and today I want to talk about interest rates and how they affect your investment. Now, ever since around 2008, interest rates have been very, very low, historically speaking. From 2008 to pretty much 2016, interest rates have been around like 10 basis points. And a basis point is 1/100th of a percent. And so the interest rate from 2016 to 2008 is around 0.1 to about 0.15. So you're basically getting, practically no interest on your debt. Now, I'm talking about the federal funds rate and not the long-term interest rate, which is more so the U.S. Treasury, particularly the 10-year. But I'm talking about short-term interest rates, so which is the federal funds rate. And the Federal Reserve, at least we think, it can control the federal funds rate through its monetary policy. And some of its monetary policy is the interest on excess reserves, which gives interest to banks for holding excess reserves. And so instead of lending the money, they could just hold the money. And so a lot of banks wouldn't lend the money. And so that would increase the interest rates. And of course, to decrease it, they can kind of lower that rate. And so a lot of banks would want to lend to each other. And of course, they can change the discount rate, which is the interest rate of which banks lend from the Federal Reserve. So if maybe a bank is kind of insolvent and no banks want to lend to that bank, the bank kind of just has to go to the Fed to get a loan, which is usually more expensive than if they were to go to a normal bank to get an overnight loan. And so by increasing or decreasing the discount rate, you can effectively change the federal funds rate as well. And so usually when the Fed lowers this federal funds rate, usually what happens is a lot of this money that banks already have is actually being stored as excess reserves. Now, the Fed has been doing quantitative easing, which is supposed to give banks more liquidity, exchanging whatever assets the banks have, whether that's treasuries or mortgage-backed securities or whatever else, for bank reserves. A lot of these banks don't really want to lend to each other. Now, I think one is because of the very low interest rates, and two is there could be another reason, whether that's solvency or whatever. So a lot of that money now has been stored in bank reserves. But usually what interest rates mean to do, what they're supposed to do at least, is they want the consumer side to borrow more, and when you borrow more, at least nominally, that's great for the economy. Or you get more spending, you get more income for everybody, and so on the nominal side, everyone's leveraged up, and everybody makes more money. Now, the problem with this is when you kind of keep interest rates artificially low, what ends up happening is people take on a lot more debt than they really can afford to service. And so then you have some long-term problems. And especially since, at the very least right now, the economy is heavily reliant on on low interest rates. And as common knowledge says, low interest rates is great for many assets, because the more you could borrow, the more money you could pour into assets like stocks, like real estate. And so usually when you have these lowered interest rates, the prices of assets like stocks, especially the growth stocks, and that's a big reason why you see all these these tech companies and all of these electric vehicle companies, their valuations have been soaring. Although, I mean, the fundamentals are no better, really, than they were, let's say, a year ago or 2 years ago. And 2 years ago, they weren't nearly as highly valued as they are today. And I won't really go on to whether they're overvalued or undervalued, but I think as a broad sector, there's a much higher chance that the whole tech and EV sector is overvalued and it's just a bubble, than that it's just normally valued or undervalued. So I think as a sector, as a whole, I think it's more expensive than some of the other sectors. And I think a main driver of that is the low interest rates, because, when growth companies have access to a lot of capital, that really enables them to grow and to multiply their earnings, multiply their companies' profits by a very significant amount. Whereas, you have some more conservative stocks, like you see the Dow Jones, that index really hasn't gained much. I mean, maybe it gained like 30% or something ever since March. So I think it's probably made back its losses. But I mean, compare that to the NASDAQ or to the Russell 2000 index. The gain is much, much lower. Now, the same goes with bonds, right? When you own a bond, you want the interest rates to go lower, because when interest rates are lower, the price of the bond increases. And the reason for that is because, the debt is more expensive. So you always have an alternative person to go to. Whereas if you own a bond, you're kind of locked in, and you can't go to that other person who's willing to sell you their debt, because no one's willing to offer you that. Whereas before, you had a higher interest rate than the market rate. And so people are willing to pay you extra for your bond instead of the lower yielding bonds that are selling on the market. So lowering interest rates is also great for bonds. And same with real estate. And real estate is it's interesting because mostly commercial real estate, the valuations of those will also rise because more people have access to mortgages at lower interest rates, and more people can pour into the housing market and thus push up prices. Now, the thing is, when interest rates go lower from when you bought, well, you kind of missed out the chance of, locking in maybe a 30-year fixed rate mortgage at an even lower rate. And so you kind of miss out on an opportunity. But the usually the price of the real estate itself will go up. And I'm going to quote Warren Buffett himself. He says, interest rates are like gravity in valuation. And so low interest rates really help push up these asset bubbles. And of course, this, I think, is something that contributes to the wealth gap that everyone's talking about, especially since now savers are punished. And so you have to also take a look at the savers side. And if you look at corporate debt, personal debt, federal debt, especially federal debt, you'll see that debt has been increasing everywhere. And usually in every recession, the debt shrinks. Well, not too much, but it shrinks. But this time, the debt has only increased. So that's something you want to take close caution for, because when interest rates are too low for too long, you could have inflation. Now, that is on the premise that banks will lend, and it's hard to say whether banks will lend or not, because for inflation, you kind of, at least the classical ways of inflation, which is people taking out loans from banks and spending, and I'm not talking about government spending causing inflation, which is certainly a possibility, but I'm talking people taking out massive loans from banks because there's incredibly low interest rates, and so everyone's spending, and that causes inflation. If you want to make that argument, you have to take a look at two sides. First of all, are people willing to borrow? And low interest rates will likely cause people to want to borrow. But you also have to take a look at the bank side, which is, do I want to lend to these guys? And, household debt, has increased. Now, I think it has shrunk a little bit ever since COVID in the United States, but in some other places of the world, household debt has actually increased. And so for banks to lend to people, well, either the banks are going to charge them more, which would technically increase at least the interest rates for personal loans, or they're just not going to lend to people. They're going to, the interest rates on personal loans are going to be so high that no one will want to take this type of loan. Now, if and when that happens, something that will almost certainly happen is you'll have massive deflation. Now, that's assuming that the government doesn't really do anything. And that's also assuming that the central bank's powers are highly limited and that they will not receive more power. And, if the central bank's going to just monetize the debt and give the federal government access to basically spend whatever money they want, well, then it's, very, very unlikely that you're going to get deflation, because when the federal government comes out here, because obviously, they have to be quote unquote generous to, well, most of it is to get votes, but they have to be generous, and their generosity is almost certainly going to cause inflation, especially if the debt cycle is due and interest rates essentially rise. And once interest rates rise, first of all, the federal government's debt will basically be impossible to pay because there's so much debt out there. And if we get, something like a 6% interest rate, which is quite reasonable, then the U.S. just can't pay back that money. And so, and same with corporations and households. And very likely asset prices are going to crash, they're going to collapse, and the Fed is probably going to come in and try to save everybody by lowering these rates again. And if they come and team up with the Treasury, federal government, and throw out more stimulus, then inflation could certainly come out. Now, what is probably the most beneficial from low interest rates is precious metals. You see, precious metals are kind of like insurance. At least they have been. They've been currency in the past, but ever since we've stopped using them as currency, they've pretty much been an insurance policy that competes against the U.S. U.S. bonds, because cash is probably the worst long-term investment you can make. And so, historically, at least ever since the U.S. became the world's leading superpower, people started coming to the United States buying the U.S. Federal debt, which is, U.S. treasuries, as a form of a safe haven, as a form of insurance against, asset crashes. And so what you get is either you get gold, which essentially yields nothing, or you get a U.S. Treasury, which could, which usually yields around 5% or 6%, historically speaking. Now, the reason why I say that, precious metals are competitors of kind of the U.S. Treasuries. Now, mostly the 10-year, because that's kind of the most popular U.S. Treasury. That's not too long-term, but it's not too short-term. And it's kind of got the best balance if you want safety. So gold, silver, these precious metals mostly are a defense mechanism. You could think of it that way, against negative real interest rates. And so when the negative real interest rates were, I guess you would say, lower, because, when you're saying lower, it doesn't make that much sense, because I guess they were more negative. Okay. Because when you multiply a negative by a negative, you get a positive. So when they were even lower, when the real interest rates, you saw gold get up to 2,000. But now it's at like 1770, 1760, something around there. I haven't checked. Because the real interest rates on the U.S. 10-year and pretty much every other U.S. Treasury also has risen. And these are two forms of insurance competing against each other. And whichever produces the greater real return will be the better investment. Now, gold doesn't yield anything, but what it historically promises is a minimum yield of 0%. And so that means you can't really have negative real yields. And that's why it's such a great inflation hedge. And if inflation is expected to come, then precious metals could be a good investment. Now you may ask, are interest rates better low or high? And my response, my answer is, I think they should be whatever the free market determines they should be. And the reason for that is, well, first of all, once you let the free market decide, you're going to have debt cycles, which is an inflationary cycle where you get people borrowing and spending. And then you get a deflationary cycle that follows, where people have to cut their spending and pay back their debt. And if they default, that's also a deflationary cycle, because the person who lended them money, well, they don't get to spend to create the inflationary cycle. And this is the cycle that, of course, politicians don't like, because, well, no one likes to have to go through a period of time where they have to cut their spending and, they can't consume as much. And so politicians and of course, central bankers, they want just to only have the fun cycle where you get to spend money, to consume, but you never have to go through the cycle where you actually have to repay your debt, where you actually have to, take responsibility for your actions. And that's why you see all this debt ramping up. And the problem is, you can't hide from something forever. It's like you have to pay it back, and you could delay the repayment date, but it's only going to be more painful when the day comes and you actually have to pay everything back. And that's the problem with keeping interest rates so low for so long. It's that, you won't have to, you could take on more debt and you could keep up your spending for a longer period of time. But when the day comes where you have to pay back your debt, it's going to be very difficult to get out of that situation. And so a pretty likely thing that the government and the central bank will choose to do is they will just, create so much money that at the end of the day, their pre-existing debt is worth so little that, it doesn't even matter if they have that much debt. Now, of course, if they create that money, that's not free. That's inflation. And inflation technically is a type of tax. And so it's kind of just a sneakier version of regular taxation, except it taxes different people unequally, you could say. But how I like to see central banks just doing all of this monetary policy is, I see it like, a cancer patient who doesn't actually want to treat the cancer, or maybe cure it in that case, but what they actually want to do is just take painkillers. Now, I guess not every cancer could be cured, but pretend it's a type that could be. It's like a person who has cancer who doesn't want to treat it and just takes painkillers. And for a while, maybe a year, maybe 5 years, maybe 10 years, maybe even 20 years, it could work out perfectly. And, you don't feel anything. Maybe your symptoms are all gone. But the problem is not the symptom. The problem is the actual cancer. And that's what a lot of central planners seem to forget, or just don't care about, because obviously if you could let the next politician take care of it and just keep on delaying the pain, then that will get you reelected.